Outlook Money's webinar, and I am Kundan Kishore, Deputy Editor, Outlook Money, and with me today are very special guests, Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential Mutual Fund, and Mr. Gaurav Doshi, Principal Officer and Strategy Manager of IIFL Wealth Management. To give you a short introduction of our speakers today, Mr. Haria has been with ICICI Prudential Mutual Fund for more than 15 years now. He is someone who drives new and existing product at the AMC and regularly interacts with distributors as well as investors across India and even abroad. Mr. Haria is also a mentor at Atal Incubation Center at Narsing Manji Institute of Management Studies, Mumbai. Mr. Doshi too has over 15 years of experience in the financial services industry. His previous assignments include Fund Manager at Morgan Stanley Portfolio Management Services, Standard Chartered Investment Advisory Services, and TSP Merrill Lynch Equity Advisory. Coming to today's discussion, demystifying ETFs. Though ETFs is not new in India, it has been there for last almost 22 years, if I'm not wrong. I think first ETF was launched in year 2000. So since then ETFs are there, but in recent past, it has got the fancy of investors. Last year, we saw quite good number of ETFs launches. So here we have two special guests today. So first of all, welcome Mr. Haria and Mr. Doshi. It is pleasure to have you here for our show. And they will just try to answer some of the investors' questions, what investors have in their mind. So welcome, Mr. Haria and Mr. Doshi.
Thank you so much, sir. It's always a pleasure to interact with you. Thank you.
So I would like to begin with Mr. Haria. Sir, could you please tell us what is index fund, ETFs, and how big is the market size, even in India and abroad?
So essentially, if you look at the way the mutual fund industry in US also evolved, and then if you look at India, which normally evolves in the similar lines what developed countries evolve. Earlier, there was a prevalence, and in US, the mutual fund industry is more than 200 years old. There was a prevalence of active funds because active funds were doing well. Then somewhere around 1950s, 1960s, the concept of benchmark index came into existence because prior to that, there was no benchmark index that was in US. And then as the benchmark index came into prevalence, the active funds were compared with the benchmark, and that's what we call outperformance versus benchmark, underperformance versus benchmark, etc. Then sometime in the 1960s or 1970s, I think, there was this first ETF or index fund launched, which basically was mirroring in US, the US index. And at that time, obviously, it was something novel, and most people felt that it will not pick up pace. And why would anyone want to invest in an index fund when active fund managers actually end up beating the benchmark? But then as the market started growing, as the financial world after 1971, see, the big impact of 1971 delinking of gold with currency printing in 1971, which President Richard Nixon did, was that the financial market started to expand significantly. And right through 1970s, 80s, and beyond, if we see, the financial markets and the savings have become much larger than what they were. That allowed more and more investment avenues people tried. They tried equity, they tried debt, they tried bonds, etc., gold. And then somewhere in 1990s, and especially after Lehman crisis of 2008, the ETFs picked up. US, you mentioned about what is the size. In US, the size of the passive industry, which is ETF and index fund today, has overtaken the active industry in 2020. So I think the passive industry size is about $6.5 trillion in US, while the active industry is about $5.5 trillion in US. Now, the big reason for this is that US pension funds are very large. There's about $30 trillion of money which US pension funds run. And before 2008 Lehman crisis, they used to invest their money with hedge funds who used to in turn invest in the markets. After the 2008 crisis, these pension funds went away from hedge funds and started investing through advisors into ETFs because ETFs were low-cost products. And that is what led to this big jump in the ETF market in US. And ultimately, you're seeing that the ETF market has become bigger because pension funds are large. Like I said, $30 trillion. The same way in India, if we see, what was the trigger point? You mentioned since 2000, there have been ETFs. And in fact, back in my investment days, I used to manage the SPICE fund, which is the Sensex Index Fund. We also had one. It's very small, very, very small. And in the last 5-6 years, since the government allowed Employee Provident Fund Organization or EPFO to start investing a percentage of their corpus in ETFs. The knowledge of ETFs increased. Then the government divestment mandates, including Bharat 22 ETF, that also helped. And much like what happened in the West, in India, post the lockdown, the number of demat accounts increased from 3 crores to 9 crores, and more people got knowledge of ETFs. We've seen ETFs grow in India. So I think the government approach of doing disinvestments through ETFs brought people there. And this financialization, which we are seeing in India, has led to ETFs becoming much bigger. So the size of ETF market in India, if I look at it today, is more than 4 lakh crores. And it is growing at a significant pace. And we do believe that in India, active, passive, all kinds of financial investments will keep growing. And ETFs, as more and more people come to know of the benefits, that's also a space which will grow.
So Gaurav, could you please explain us what kind of investors typically invest in index funds or passive funds? If you can just explain us.
Yeah. So I think picking up on a point that Chintan talked about is that we, in India at least, you have to acknowledge the fact that it was pension funds that were the early adopters to this passive investment space. It is just by sheer quantum of the money that they manage and the longevity of the investments they make. They always battle this dilemma of how to generate returns, but yet keep costs low. And when the passive investment space in India offered them an option that addressed both these concerns, which is provide certainty of returns along with keeping costs low, we saw them, warm up to the space tremendously. Now, it is because of this early patronage that by these institutions, by these pension funds, that we saw a massive swell in AUM at a time when nobody was even talking about the space, and it was very little was known about it in India. It is this swell that motivated manufacturers, asset managers to look beyond the vanilla index fund of just Nifty and Sensex. And we actually saw, within asset classes, more passive products getting launched. So the offerings started getting deeper. And we also saw the offerings get wider in the form of different ETFs and passive options across fixed income, commodities, and in the international space. Now, when the bouquet of offerings increased, we saw a new set of investors in the form of wealth managers, large family offices, extremely large individual investors start to use these products as a great way of refining their overall portfolio construction. Because portfolios are really constructed to achieve certain goals or to achieve certain objectives. And when you have a situation where now you have a lot more building blocks available, it allowed this community to start refining their portfolios even more so that they could achieve specific objectives. So I think we saw them also embrace the space extremely well. And in the last 3 to 5 years, whether for multiple factors, we've seen even retail warm up. Whether it is retail investors looking to begin their equity investing journey through a vehicle that is benchmark hugging and low cost in terms of its profile, or whether it is a lot of investors who are just looking to get inflation beating returns over the medium to long term, but don't have the time to really don't have the time to kind of spend in researching or studying the active space, or don't probably have access to good quality advice. We've seen a lot of them also warm up to the passive investing space. So what's amazing to notice is that whether it is a 5 lakh rupee investor, a 50 crore rupee investor, or a 500 crore rupee investor, all three of them have found some utility from the passive investing offerings. And I think that alone speaks volumes about what the value proposition of passive investing options are today.
Okay. So Chintan, Gaurav has rightly mentioned that there is a wide range of products available in this ETF space, and we have seen a quite new kind of products in especially last 1 year, 1.5 years. So could you please tell me, can an investor, if somebody wants to investor like me, if I want to build a portfolio, so can I build a complete portfolio with ETFs?
Sorry, it's a very good question. And if you look at from an investor perspective, our objective as a ETF provider is that the investor should be able to create the entire product bouquet or portfolio with ETFs. If you look at it in the last 4-5 years, as Gaurav was mentioning, with more investors looking at ETFs, there's also been a drive by manufacturers like us and mutual funds like us to provide various options to the investors. And I think the regulator has also played a very good role in terms of ensuring that the ETF market is known to the people across the board. So if we look at what is available in terms of the product bouquet today, and I'm sure a lot more products will be available on the ETF space, you can pretty much create an entire portfolio. Let's look at an investor. An investor, if he is looking at investing in pure equity, they would have large cap, mid cap, small cap exposure that they want. They want Nifty Next 50 exposure, for example. All of that is available, from a ETF and index fund providers. If we look at debt, then there are 5-year GSEC, 10-year GSEC products which are available in the market, which people can invest in through. On the index fund side, there are SDL plus PSU target maturity products which are available for investors to invest in. So that's also, if I include ETFs and index funds together, there's a lot of variety. Gold and silver, which you were speaking a little while earlier, gold and silver ETFs are also available, and most people in India, do invest in gold and silver, uh, maybe as physical jewelry, etc. But there is merit to basically invest through the financial route also in gold and silver, a certain portion, to have an overall balanced diet. Along with market cap base, then now you have over the last 2-3 years, you're seeing if someone likes auto, for example, and auto is a sector which is doing well right now and expected to bounce back after the problems which it saw in the lockdown where volumes were not available because of chips not being there or generally people not being there on the road so much for demand being improvement. In the next 2-3 years, if the demand is going to improve, then you can have an auto ETF as part of your bouquet. Banking, if you like, or private banks, if you like, that also is an option that you have. Consumption, FMCG sectors, defensive India being a multi-decade consumption story, you have that also as an option. So I think, and export basket, India is known for being the world's largest outsourcer of technology. India is known for being the largest pharma provider to the world. Then you have the pharmaceutical or healthcare ETFs, or you have the IT ETFs as well. So I think if an investor wants to create a portfolio basis, the investor's knowledge, everything is available, all sectors are available. And last part, the bridge between active and passive, right? So while all of these indices which I spoke so far are either sectoral or market cap based, there is a bridge in between which is called the smart beta ETFs, right? Which basically have their stock selection mechanism on the basis of a factor, much like how an active fund manager has a value bias or a growth bias or a dividend yielding bias, or they are very high, they like to buy high ROE companies. There are products available on the ETF side also, which basically take these into account. So if you look at, let's say, the NV20 as an example, and the index has selection of 20 stocks on the basis of 50 stocks, which are based on ROE, price to book, price to earnings, and dividend yield. Then you have the low vol 30 ETF, which basically takes into account the lowest volatile stocks or steady stocks in the long run. So you have many such choices. You have momentum as an index as well. So there are many options which are available and basis the client's requirement or the investor's requirement. And I'm sure Gaurav can elaborate because he interacts with them a lot. You can create the entire portfolio. In fact, must be creating for the portfolio for the investors as well. So, like I said, all the structure is in place. And as we move along, if investors do need more products as manufacturers, we are definitely going to provide that as well.
So basically, for any successful investments, your asset allocation matters. So
Correct.
we can do the complete asset allocation with the help of ETFs.
Absolutely. Absolutely.
Okay. So Gaurav, could you please tell us what are the pros and cons of investing in active funds and passive funds? If you can just elaborate.
So, I think it's important to acknowledge the merits and demerits of the passive space in isolation, and then just see how that corresponds to what the active funds offer, because both of them have their unique offerings. But I think the biggest positive to start with, and in my opinion, the most underrated one, is the extremely low fee set that the passive space comes with. And this is underrated, I say so, because the benefit of this only amplifies with time. Right, the lower fee, if you stay put in that index fund for maybe 5 or 7 year period, can actually add a meaningful incremental return profile to your overall return set in the long term. So I think that's one of the most positive things that the passive set offers today, which is distinctly unique versus the active space. I think secondly, today, I think taking on from where Chintan left, that the fact is that when you look at the ETF space, you can literally look at them as building blocks because of the sheer diversification of offerings. You can really look at using them as building blocks to create portfolios. But the point is that today, when you're allocating money to these, making certain allocations, the expectation that you are that of what it is that you're allocating to do is important. Now, let me come, when I talk about transparency, I'm talking about the fact that today if I buy an index fund, I know exactly what sort of stock profile I will get. I can track that index back since its inception, look at its standard deviation, volatility, peak drawdowns, and get some sort of estimation of how that investment will fare going forward based on the data that I have available. So there is very little room for any surprises. Secondly, even if I were to talk about the factor funds that Chintan talked about, whether it is growth, whether it is a momentum value, the process of how that will run is very clearly defined. So one can, as an investor, be very clear about how or the methodology that will be used in the running of these portfolios, and therefore make the right allocation to ensure that the money that you have allocated is doing exactly what you have set out to do it. And another thing about the transparency factor is, like he did talk about the fact that today in the fixed income space, you have these roll down target maturity funds that are there. It's very defined what the universe will be. It is very defined what the maturity profile will be. So let's say, for example, I create, I put one third in a 24, in a 27, and in a 29 maturing fixed income ETF, and I create a laddered portfolio, which now for the next 7 years or 8 years, I just simply want to hold and forget. Then the justification for someone to want to actively manage that, when it is surely just about buying and holding for such a long period of time, gets very difficult to make. And therefore, it's again the transparency which is allowing me to lock things in and then be patient and visit. One very important factor that I think is also there is that today, if I were to make an allocation to the large cap space through an index fund, my expectation from that investment is that it will consistently track the benchmark it is set out to track. Now, unfortunately, what happens is that when certain stocks, let's say as an example, a stock goes to 12 or 15% weight in the index, unfortunately, active managers, due to risk control mechanisms, can't replicate that weightage or can't kind of go equal weight to that weight. And that's when we start seeing an active manager start to underperform his benchmark by virtue of just not being able to allocate enough. And so that's why it becomes even harder for an active manager to then, recoup and recover. And this is a dilemma that passive funds don't face. So you will always be certain that your return profile will always mirror the benchmark that it is determined to mirror, irrespective of what the underlying stock wages or corporate action that takes place. Lastly, I think it's also important to understand that passive is its method, the method is already determined, right? So today, when you have situations in our markets, which are ever changing, where you have a switch taking place from growth to value, which is something we witnessed last year, or when you have a sector that's emerging as a potential front runner over the next 12 to 18 months, something that we witnessed in commodities and energy sector last year, the passive fund will have that exposure and allows you to participate in that change since the early start. And the early days of these big changes that take place is when actually a lot of meaningful money gets made. Active managers typically will do a lot of research. They will look for quantifiable fundamental data for them to form an opinion, and basis that opinion will then realign their portfolios, which again could take a certain amount of time. So it's just that sometimes the passive space allows you to participate in these things a lot earlier, and when there's a lot more meat left on the table versus when the rest of the herd joins that race. But for all these positive, I think there is definitely some value add that the active space will do, which the passive at this point in time would be, I would consider our limitations there. And one of the facts is that today, when you look at using passive beyond the obvious large cap, liquid, or the AAA universe in fixed income, I think what typically starts to happen is one starts to facing a little bit of a tracking error issue. And unfortunately, tracking error is something that at once created is very hard to recoup in the passive funds. Having said that, I believe that today, if I was to allocate a significantly large amount of money to say a small cap ETF, by process that they will deploy all that money on that single day into the basket. Now there may be certain stocks that are illiquid, right? We see a certain spike in volume due to the sudden gush of money, or certain stocks which are on circuit where the ETF is not able to get the order and will have to chase it for a few days. An active manager typically here would look at how the liquidity is, look at how to place the order, maybe spread it over 2 or 3 days, add a little bit of a human angle to that, or B, look at saying that, look, the stock price has gone up too much, let's not chase it for now. So I think that's definitely that's a value add that comes. And lastly, I think pension funds, institutions today have had the ability to directly access creating units with asset managers. And that is an extremely efficient way to participate in the passive space. But unfortunately, the quantum for that, it puts it out of reach for a lot of small and mid-market investors. Now, these investors would either use the index fund route or go on the screen and look to buy the ETFs. In most cases, it works out well, but we've seen that on volatile days. And unfortunately, our market's seen a lot of volatility in the last 2 to 3 years. But on volatile days, that spread that the market maker that exists for retail to buy versus the actual NAV of that ETF tends to increase, and therefore negating one of the biggest benefits of an ETF, which is low price. So, while I believe these are issues that exist today, I'm also aware that asset managers, along with the regulator, are actively working on addressing all these issues. And therefore, I believe that these issues which exist today are merely passing. I believe that they are not significant enough that should deter people from considering passive investments, or at least beginning their journey in the passive space. And with time, like I said, with the oversight of the regulator and the hard work of the manufacturers, I believe that these are issues that will definitely get addressed.
I think Gaurav is a big fan of ETFs and index for passive funds. So Chintan,
I believe in a best of both worlds.
Okay. So here, Chintan, I would like to ask you how one can choose the best index fund or ETFs, because there are a couple of factors like, as Gaurav mentioned, tracking error. Tracking error, it influences the performance of the fund to an extent. So these are the factors. So in that scenario, what are the factors one should consider before picking any index fund or say ETF?
Sure. So taking a cue from what Gaurav mentioned as the pain areas as far as ETFs in India are concerned, one was obviously liquidity. And I think with the recent regulatory changes, like I said, the regulator has been proactive in ensuring that the investors get the best on the ETF space. I think the liquidity on the exchanges is set to improve significantly. And we as asset managers would also be inclined towards doing everything that we can to ensure that the spreads, etc., are narrowed down. I think recent regulatory changes should help there. Apart from that, what investors should look at when they are looking at an efficient ETF on their bouquet, one is what you mentioned, tracking error and tracking difference. Tracking error is essentially how much the fund is exactly mimicking, copying, or following the index, which it is basically supposed to follow on a day-to-day basis. And if there is variation between the index returns and the fund returns on a day-to-day basis, you calculate, there's a standard deviation calculation. It essentially, tracking error essentially shows you if the tracking is not being done on a proper basis. Now, while there are regulatory limits around that as well, the tracking error and tracking difference now is being, from a regulatory standpoint, is something which needs to be disclosed regularly, and investors can look at it and lower the tracking error. More efficiently is the fund being managed. Now, tracking error also, if you should look at category by category. I think what Gaurav was basically mentioning, that small caps by definition of managing a small cap fund is very difficult because of the upper circuit, lower circuit, etc. So there the tracking difference is going to be higher. It still does not deter an investor from building the portfolio, but yes, tracking difference can be slightly higher in smaller caps. But large caps, smart beta, etc., where the universe itself is large caps in general, we've not seen an issue. And I think progressively the industry itself, through efficient mechanism of managing the funds, reducing the cash that they used to keep in the portfolio, etc., and efficient rebalancing mechanisms, have ensured that tracking error is lower. So you basically look at the tracking errors, they are available across the board. Although tracking error should not be the single decision-making point, because ultimately the decision should be that whether you like auto, you like small cap, you like large cap, it fits into your overall balance of the portfolio. So like Gaurav, I mentioned, asset allocation is important. Within that asset allocation, then once you've narrowed down on where you want to invest, then within that you can look at, let's say, for example, expense ratio. The lower the expense ratio, the better it is. Tracking error, the lower the tracking error, the better it is. Tracking differences in any two time periods, the performance of index compared with the performance of the portfolio or the ETF. If they are narrower, it's great. The lower the tracking difference is better. And ultimately liquidity on the exchanges, which like I said, it is in the interest of all the manufacturers to ensure liquidity on the exchange. And with more and more people getting into the ETFs, I think liquidity on the exchanges tend to improve. And with market makers being there, I do believe that that will also improve. So I think it's a very simple product where first you decide what fits into your asset allocation. And once you've decided the underlying product, then you just look at the expense ratios, tracking errors, and liquidity and invest. And within that, I think the expense ratio will play a key role. So lower the better. Tracking errors are generally in the industry in the same league.
Gaurav, could you please tell us what kind of investment strategies investors are using with the ETFs and passive funds?
So today, if one has to answer that question, I think the simpler analogy I would use right now is that passive funds as building blocks. So simply put, if I give you 5 blocks of Lego and I give Chintan 5 blocks of Lego, the end result of whatever both you all create will be extremely different. The strategy that people are today putting into place is really about what their personal requirements are, what is the time frame, what are their growth orientations, what are their goals, and therefore we're seeing an extremely diverse profile of strategies that are emerging. Having said that, my role today in IIFL Wealth requires me to think a lot about portfolio construction, and we spend a lot of time thinking about how do we address the active versus passive dilemma. And our assessment basically tells us that when you are able to kind of get a blend of both active and passive to work together, that is the most lethal combination, at least basis our analysis. And that typically also results in the most favorable outcome. Now, it's simply about getting the right vehicle to get the right exposure. We have always been a market which has been a very product push market, where initially you had a product and you would just find some reason to look at putting it. This by virtue of there being very few options. But today, when you are looking at approaching relationships on a holistic level and looking at portfolio construction, asset allocation, goal orientation towards portfolios, then we realize that figuring out what has worked when helps us, basically fine tune our offering. Now, historically, what we've seen is that when markets are volatile, when the economy is weak, when you have a disparity in sectoral earning profiles, we've actually seen that active managers have historically outperformed in these periods of time. But when you've had a period of time where stocks move in unison, when maybe there's a lot of liquidity, when you have earnings upgrades across sectors, it's also created an environment where passive has actually worked better than active, right? So what we've come to the view is that if you take passive and look at an extremely large liquid universe, whether it is, or high quality universe, for example, in fixed income, which is extremely easily traded and where much is already known, so that we believe an active manager can't really add too much more value because there's already so much that's already out there. Or even if he's able to, we don't think he'll be able to do it consistently over the medium to long term. We think that using this small, large liquid universe, which is of high quality and typically that's always the biggest part of the portfolio, to get that exposure using the passive space, we believe is a thought process that we follow, because it gives us low cost, high quality exposure in a space that has typically got a very low tracking error, and where we believe that in the medium to long term basis, consistently an active manager, just by virtue of the fact that there's so much known already, will not be able to consistently find enough information to generate meaningful alpha. But portfolios, unfortunately, are not always just comprised of this, right? We have to look at creating diversification, even if it is across asset classes, even within an asset class into different places. But when we have to look beyond for our portfolios, when we look beyond what I just talked about, we found that there are times when an active allocation actually is warranted. Now, this is something for us, we look at when we have an extremely large universe that we're working with. And in that, we want to try and get a niche exposure for ourselves. Or the universe we're looking at is extremely illiquid. Or it is a space where fewer people are watching. In that, then that tells us that an active manager here has a higher probability of finding the diamond in the rough. And in turn, then helping generate that sort of outperformance that we are expecting from them. So, when you look at something like, for example, in fixed income, if I looked beyond AAA and maybe looked at something like credit, if in equity, if I looked beyond large cap listed, maybe I looked at the small cap space, maybe I looked at the pre-IPO unlisted space, maybe I looked at private equity, etc. These are segments that require a lot of research to begin with. Require a lot of effort to construct a portfolio, require even more effort to monitor and review that portfolio consistently and to ensure that timely exits are made. And therefore, we believe that there is merit in having that active oversight to ensure that our money that's allocated here is delivering what it's meant to do. And the hope is that this excess that is being done will help generate that meaningful benchmark beating returns that we will be expecting from it. So in short, I think having a blend of both and a combination of both is really what, in our opinion, is a very effective way. But finally, how much to allocate to which side is going to be a question of how could your advisor or your analysis.
Chintan, actually, these days we have heard a lot about smart beta ETFs. So could you please just simplify this? What is this smart beta ETFs, and how this product is unique in this ETF space?
Sure. So traditionally, ETFs were known to be, let's say, large cap ETFs. So you have the top 50 names put together, top 30 names put together, or top 100 names put together. Then you have, let's say, the mid cap ETF, where you have 101st name to 250th name put together in the proportion of their weightages which are there in the index. These are purely on the basis of market cap. Smart beta is essentially a selection of stocks is done basis factors. And like I said, factors could be volatility, alpha, momentum, value, dividend yield, etc. So in the global universe, when interest rates went to zero, dividend yield as a factor became very, very prevalent. And people basically started to invest in dividend yielding funds globally. So dividend yielding funds became a very important factor for people to invest. Back in India, if you look at it, we've seen people wanting smart beta products across the board, and where the pickup significantly has been seen, for example, in momentum as a smart beta factor. We've seen low volatility as a smart beta factor. Now, what is smart beta? At the crux of it, it is selection of the stocks on the basis of one or more factors in a predetermined manner. So to give it an example, let's take the low vol 30 index. There, the universe is 100 stocks. So out of top 100 stocks, the methodology says that you have to pick up 30 stocks which have shown the lowest volatility in the last 1 year. In effect, these stocks are the most stable stocks. And once these lowest volatile 30 stocks are picked up and selected, their weightages are also determined on the basis of the stock which is lowest volatile will have the highest weight, and so on and so forth. So essentially, smart beta is the construction of the index itself. It's not on the basis of market capitalization or on the basis of ranks of a company, but on the basis of factors. And the factors are, as I said, momentum, low vol, etc. So once you do that, and then every quarter or every half year, the back testing will be done, or the index provider will see which are the stocks which are the lowest volatile. And if any rebalance is required, the index will get rebalanced. So in effect, all passive schemes, while they are supposed to basically mimic the index itself on a quarterly basis or half-yearly basis goes through a change if required, basis on the methodology. And that is what probably makes the smart beta universe very, very interesting for the investors, because the 30 stocks which are most stable today, there could be another 3-4 stocks which have become more stable. And so those three stocks will come in, the other 3 stocks will go out. And through this mechanism over a period of time, the investor basically gets the benefit of being invested in the low volatile universe, or let's say the momentum universe, wherein the momentum of stocks keeps changing. So you will be in the momentum oriented. Now, as Gaurav was mentioning, each factor, each set of stocks or each set of styles goes through its cycles, and we saw growth or quality do exceedingly well in India between 2015 to 2020 October specifically. After October 2020, we've seen value do well. So it will have to be an investor who is guided well by the advisor or people like Gaurav who can actually guide them as to where their money should be for them to be able to make the most of these smart beta products.
So now wrapping up this discussion, and in fact, my last question to both of you. What can be foreseen for the future of ETF products as more clients adopt to passive way? In fact, can we start with Chintan?
Sure. So if we look at India, India's wealth today is about $10 trillion and only 4 or 5% is in equities today, despite all the growth that we've seen in mutual funds and people investing directly as well, number of demat accounts. Only 5 or 5.5% of our total savings is in equities. So clearly equities as a way of growth is going to be there with new generation coming in, digital savvy, etc. And so ETFs will play a big role. Like Gaurav mentioned, it is never active versus passive for us. It is active and passive because all financial instruments will see growth. And we do believe as more savings is channelized across asset classes, you will find ETFs also grow significantly from where they are. And I think the biggest boost, of course, is that if the pension fund trusts keep on investing and they are in fact looking at increasing their investments as well, that would mean that the ETF growth trajectory continues to improve. And with more and more investors also getting the knowledge, we have no doubt that with well-managed ETFs at the back end, wider universe available of ETFs for investors to invest, and the knowledge that has been created over the last few years and will continue, ETFs are here to stay and keep growing exponentially over the next maybe 5-10 years in India. Gaurav, over to you.
So in addition, I think, I would definitely say, my headline for the future would definitely be that beta is becoming free. Technology is almost vanishing cost. And because of these two critical factors, like Chintan said, passives are here to stay. The question is that every different type of investor is going to derive a different benefit or a different utility. So it's hard to pin down one specific reason, but there are more than enough reasons why it's going to become an essential building block in client solutions and client portfolios in the future. Now, simple logic here is that they benefit from such a virtuous cycle, right? Lower costs result in lower fees, which results in higher AUM, which in turn results in yet lower costs. So as long as this virtuous cycle exists, they will always be a very big force to contend with. So I think the fact of the matter is that now in the future, it's not really going to be about active or passive, or it's going to be about active and passive. And it's really going to be a bottom line about structuring, implementation, execution, and monitoring of solutions and portfolios that will be a combination of both active and passive that will determine the experience and the outcome for investors in terms of returns and achieving their targets.
Great. So basically ETF has come a long way and it has very long way to go in future. So thank you so much, gentlemen, for sharing your insights with our viewers. And it was really a great informative session. And I believe our viewers will get benefit from this. Thank you. Thank you so much, sir.
Thank you.
Thank you so much. Pleasure.